Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Why it pays to borrow when inflation is high and interest rates are low. Inflation as measured by the CPI index, in other words the Consumer Prices Index, reached 5.1% in the year to November 2021, up from 4.6% in October. But the RPI, Retail Prices Index, rose to 7.1%. The Retail Prices Index, or RPI, is relevant to mention because it is the one inflation index that includes mortgage costs. This is the highest rate of inflation in the UK for 10 years. The question is, will inflation persist at these relatively high levels or go even higher? Also, will interest rates rise more following the tiny increase in the base rate by the Bank of England from 0.1% to 0.25% on 16th of December last month? Whilst I do not possess a crystal ball, it does look probable that interest rates will rise further and that a higher rate of inflation is likely to persist for some time to come. The longer the government takes to increase the base rate by a more meaningful amount, the more likely the pound will weaken, which will further increase inflation because imports will become dearer. This appears to be the likely scenario being played out. Of course, the government will state that inflation is temporary and the base rate doesn't need to be increased, but that's politics for you. Having lived through the 70s when inflation averaged in the teens and the base rate rose to 17%, I, for one, am never complacent about inflation and interest rates. I certainly don't expect things to get as bad this time around, but a rise in inflation and interest rates by a few percent over the next year or two wouldn't surprise me in the least. Bearing in mind that the base rate has averaged about 4% over the last 200 years, a return to that level is certainly not implausible. So if you own a property and you have a mortgage, the question is, should you reduce or pay off your mortgage entirely if you can afford to do so? I would argue that now is not a good time to repay debt, especially cheap debt. For most people, the cheapest debt they have is mortgage debt. Mortgage deals can be obtained at rates of less than 2% per annum currently. If you were to secure a mortgage rate of 2% or less for a 5-year fixed rate mortgage, that would represent excellent value for money. This is on the basis that the money you could have used to pay off your mortgage is invested instead. By invested, I do not mean in a bank account, but in a fund or funds which are predominantly invested in equities or shares. Bearing in mind the dividend yield on the FTSE 100 index of shares is estimated to be 4.1% for 2021, before factoring in any capital growth, it is hard to imagine how you could be worse off investing in shares over a 5-year period, unless, of course, there was another black swan event such as the coronavirus pandemic. The dividend income alone will more than cover the interest cost. Estimating potential investment returns against low-cost mortgage interest rates is one thing, but what about the effect of inflation on your debt? You see, if you were to take out a 5-year fixed-rate mortgage over 5 years, and RPI inflation average, say, 5% a year, then the real value, in other words, the inflation-adjusted value of your mortgage would decrease by 27.62%, even if you had repaid none of the capital. A compelling reason, if ever there was one, to borrow when inflation is high. You repay your debt with depreciated money. So when you think about it, your investment would have to fall by more than 27.62% over a 5-year period for you to be worse off in real terms, which is unlikely to happen, especially since we only had a market crash less than 2 years ago when coronavirus became a pandemic. Of course, in 5 years' time, the situation could be completely different if, for example, inflation were then under control and interest rates were a few percentage points higher. Arguably, that may then represent a better time to repay debt. Only time will tell. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.